China, once held as the world's economic miracle, is now facing a crisis. From a collapsing real estate market to mounting debt, the Chinese economy is showing signs of serious strain. But why is this happening? Let's dive deep into the factors behind China's economic slowdown. China's real estate sector, which accounts for nearly 30% of its GDP, has been the backbone of its growth for decades. But this reliance has created a bubble. Major developers like Evergrande are now drowning in debt, leaving millions of homes unfinished and household wealth eroded by an estimated $18 trillion. Why? Local governments over-relied on land sales to fund themselves, while lax regulations allowed unchecked borrowing. Now the bubble has burst. China's debt is soaring, reaching a staggering 300% of GDP. This includes government, corporate, and household debt. For years, cheap credit fueled massive infrastructure projects, but many of these projects now generate little to no economic return. Local governments in particular are struggling to repay debts, raising fears of widespread defaults. China's push to dominate global manufacturing led to the construction of countless factories. But now, many of these facilities are underused. Overcapacity in industries like steel, cement, and solar panels has driven prices down, making these sectors unprofitable. China's population is aging rapidly, and its workforce is shrinking. One-child policy implemented decades ago has left a demographic imbalance. Fewer younger workers mean less productivity, while a growing elderly population put pressure on social services and pensions. China's economy heavily depends on exports, but global demand is slowing. Trade tensions, particularly with the US, have led to tariffs and restrictions on Chinese technology. Additionally, foreign companies are diversifying their supply chains, reducing reliance on China due to political uncertainties and the COVID-19 pandemic's disruptions. China's consumers are spending less, reflecting a lack of confidence in the economy. Job security, falling properties values, and uncertainty about the future are leading many to save rather than spend, creating a vicious cycle of reducing demand and slower growth. Beijing's heavy-handed policies are also to blame. Crackdowns on private tech giants like Alibaba and restrictions on property markets have shifted innovation and investment. Additionally, efforts to control dissent like silencing economists who questions the government's statistics have damaged credibility and transparency, making it harder to address systematic issues. China is now facing the risk of deflation, a scenario where falling prices lead to lower consumer spending and corporate earnings, further slowing growth. If not addressed, this could spiral into long-term economic stagnation.